Okay, let's dive into this. Welcome to today's Explainer, where we're mapping out the ultimate investor's roadmap. Look, if you already follow the market, you know that real estate isn't some kind of magic trick, right? It's just mechanics. So today, we're putting a highly structured, totally actionable framework behind all these concepts, so you can walk away ready to navigate real estate investing like an absolute pro.
Right out of the gate, let's just completely shatter the single biggest psychological barrier out there. This huge myth that you need a massive pile of cash to get started. Just look at Coach Carson. He built a truly formidable real estate portfolio, and he literally got started with only $1,000 in his bank account. No secret trust fund, no giant inheritance. It was just pure hustle, smart leverage, and strategy.
So that begs the question, do you really need a 20% down payment? Absolutely not. No way. Owner-occupant loan programs let you bypass that hurdle completely. For instance, eligible veterans can leverage a 0% down VA loan, or you could look at an FHA loan, which sits at just 3.5% down. To put that into perspective, on a $200,000 property, you'd only need about $7,000 to secure the entire asset. All right, here is our roadmap for today's Explainer. First, we're breaking the cash barrier. Second, REITs versus rental properties. Third, residential versus commercial. Fourth, calculating your ROI. And finally, number 5, avoiding beginner mistakes. So let's jump right into section 1, breaking the cash barrier.
If you want to start without totally draining your savings account, one of the most powerful strategies out there is called house hacking. And this brilliantly illustrates how you can use your own living situation to build wealth. It basically means generating rental income right from your primary residence to offset your costs. So you buy a duplex, you live in one side, and you rent out the other. Because it's your primary residence, you qualify for those low down payment loans we just talked about, all while your tenant is essentially paying your mortgage for you. It's a total win-win. Okay, so once you've secured that first asset, how do you actually scale up? Well, you use something called the BRRRR strategy. That stands for buy, remodel, rent, refinance, repeat. The idea is you buy a fixer-upper, you physically force the property's value to go up by doing renovations, you rent it out, and then you refinance the property based on its new, much higher value. By doing that, you can literally pull your original cash back out and recycle those exact same funds for your next deal. Get this, another brilliant, low-money entry point is the live-in house flip, and the tax advantage here is frankly staggering. Under U.S. tax laws, if you live in a home for at least 2 out of the 5 years before you sell it, you can take up to $250,000 in profit completely tax-free. And if you're a married couple, that doubles to $500,000. It is, without a doubt, one of the most powerful wealth accelerators hidden in the tax code. All right, moving right along to section 2, REITs versus rental properties.
So, at this point, you face a major strategic choice. It really boils down to this. How involved do you actually want to be? On one hand, you have real estate investment trusts, or REITs. These are paper assets, right? You just buy shares like you would a stock. They are super passive, highly liquid, and very easy to get into. But you do sacrifice operational control, and you're subjecting yourself to regular stock market volatility. On the flip side, direct rental properties are tangible, active business assets. You get direct control and those incredible tax advantages we mentioned, but they definitely require serious hands-on management and higher upfront cash. Now, what's really interesting about this slide is exactly why REITs are such a powerhouse. It comes down to the law. REITs are federally mandated to distribute at least 90% of their taxable income right back to shareholders in the form of dividends. So if you're looking for incredibly consistent, totally passive cash flow, without ever having to go unclog a stranger's toilet at 2 in the morning, REITs are just a massive wealth-building vehicle.
Let's move to section 3, residential versus commercial real estate.
If you do decide to go the tangible, physical property route, you've got to pick your terrain. Commercial real estate, so we're talking office buildings, retail spaces, large complexes, that generally offers higher yields, mostly because you're leasing to businesses. But it takes a lot more capital to get started, and it's highly sensitive to economic cycles. Residential real estate, like your single-family homes and duplexes, might offer slightly lower yields, but it gives you ironclad stability. Think about it. Even in the middle of a brutal recession, people are always going to need a place to live.
But I have to say, one of the absolute greatest tactical advantages in the commercial sector is something called a triple net lease. See, in residential, the landlord usually eats the costs for taxes, insurance, and maintenance. But with a triple net lease, that entire financial burden shifts over to the tenant. The business pays you your base rent, plus they cover all the property taxes, the insurance premiums, and the upkeep. It is a fantastic way to create a bulletproof, totally predictable cash flow.
So the crucial point is, we need to know how to measure success. Let's look at Section 4, calculating your ROI.
Regardless of which sector you choose, success literally lives and dies by the math. Here is the strict, step-by-step formula you should use to evaluate any deal. First, figure out your expected net rental income, then subtract all your operating expenses and your financing costs, like your mortgage. That number right there is your actual cash flow. Next, you want to factor in the property's estimated appreciation, which historically sits around 3 to 5% annually. Finally, just divide your net income plus that appreciation by your total initial cash investment. Boom, that gives you your true return on investment.
Now, it is super important to differentiate between your metrics here. Short-term ROI, which is often called cash-on-cash return, is a really strict measure of your immediate liquidity. It's only looking at the actual cash hitting your pocket right now relative to your down payment. Long-term ROI, or total return, tracks your overall wealth accumulation. It gives you the complete macro picture because it combines your cash flow, property appreciation, and all those sweet tax deductions.
Okay, bringing us home to Section 5, avoiding beginner mistakes.
Let's move to and see how this builds up. Because small oversights in real estate, they compound into massive, massive losses. Here are the guardrails you need to stay on track. First, ignoring unexpected expenses will absolutely destroy your ROI. You should always budget 1 to 2% of the property value every single year just for repairs. Second, never misprice your rent based on a gut feeling. Use real local data. Third, don't buy a property just because you like it. Buy it because it aligns with local tenant demand. And finally, trying to self-manage without a professional system in place pretty much guarantees high tenant turnover and total chaos.
And actually, speaking of empty units, I want you to hard code this specific number right into your brain. 5 to 10%. You cannot realistically model a property, assuming you'll have 100% occupancy every single year for the rest of time. It just doesn't happen. You absolutely must budget a 5 to 10% vacancy rate to absorb those empty months between tenants. If you fail to build in that buffer, you're looking at a phantom ROI, and literally just a single 2-week vacancy is going to completely wreck your budget.
You know, newer investors often try to save 8 to 12% by just skipping property management altogether, but honestly, this is a total false economy. A professional property manager minimizes those expensive vacancy periods through aggressive marketing. They optimize your rent using deep, real-time market data, and crucially, they ensure that you stay compliant with highly complex landlord-tenant laws. Frankly, avoiding those legal headaches alone is usually worth far more than whatever fee they charge you.
Wow, okay, we have covered a tremendous amount of ground today. Everything from completely bypassing the cash barrier with house hacking, all the way to deciding between the easy liquidity of REITs and the physical, tangible control of direct rentals. The mechanics are laid out super clearly right in front of you, and as you've seen, the barrier to entry is so much lower than the market wants you to think. So I'm going to leave you with this. Which real estate path actually fits your long-term strategy? And most importantly, are you ready to make your first move?